Welcome to another wonderful version of online macroeconomics. In this particular lecture, we're going to be introducing gross domestic product. Gross domestic product. This chapter is called National Income Accounting. Well, accountants are basically economists without personality, so sorry to throw a little zinger there at the accountants, but any business would typically have both financial and managerial accounting. So managerial accounting is the type of accounting where you measure sort of your own sales growth, your own market share, those type of things, or profitability measures. And businesses, any smart business anyway, would do this month to month or quarter to quarter, and they'll do it to sort of get a feel for where they are compared to where they were. And that's the same idea of why, as a nation, we perform this national income accounting. So the Bureau of Economic Analysis measures what's called gross domestic product, right? GDP, gross domestic product. I'm sure you've heard of GDP, or at least I hope you've heard of GDP in your lifetime at some point, right? So GDP, gross domestic product, in broadest terms or in simplest terms, gross domestic product is a measure of the economic activity which takes place here in the United States. It's a measure of how many goods and services we produce. And we're going to get into a much more detailed definition of GDP on the next slide and the following slides. But first of all, let's talk about number one. What is national income accounting? Why is it important? What does it have to do with GDP? The first idea is simple: is that we measure how much economic activity takes place, how many goods and services the United States produces. All right, so I want to talk about this in another slide. We measure this in dollar terms, monetary measure. And then the second reason why we do this, we don't just measure it to see how large the economic output was for the year. The next important idea here is that we compare economic activity for this period to prior periods and to long-term averages, right? So we say, okay, is the economy growing? If it is, at what rate is it growing? If it's not growing, if it's faltering, if it's shrinking, at what rate is the economy declining? And then the final third reason why we have national income accounting and why it's important is that if necessary, after we've measured economic activity and after we've compared it to historical norms, then if necessary, we'll make policy changes. And it's never too early to introduce new economic concepts. These policies are typically referred to as fiscal policy and monetary policy. Fiscal policy carried out by the federal government, right? Fiscal policy carried out by the federal government, and monetary policy carried out by the Federal Reserve. And there will be entire lectures, entire chapters dedicated to fiscal and monetary policy. So right now we're in 2012. Maybe you'll be watching this video in 2014. Hopefully by then the economy will have improved greatly. But currently we're at 8.2% unemployment, and it got as high as 9.8% unemployment. So what policy measure changes might be in order given our measurement of economic activity and our comparison to historical norms? All right, let's get into the heart and soul of GDP, the gross domestic product, the definition of it. First of all, it's a market measure. It's a monetary measure. In other words, we add up GDP in dollar terms. So, we measure economic activity based on goods and services at prevailing year's prices, right? So it's a market value. And this is important here of all final goods and services, Right, so we avoid what's called multiple counting because we do not include intermediate goods. Right, we would be guilty of multiple counting. So first idea is it's a monetary measure, market value of goods and final goods. So for instance, final goods versus intermediate goods. Imagine if Ford Motor Company's cranking out some sedan. I don't know what the name of their latest model is. They change it so often, but right. So the final market value of that automobile might say, let's just guesstimate, let's say $26,000. So we would add $26,000 to GDP as a nation based on the market value of that car, as opposed to including all of the intermediate goods as well. So we don't count the value of the transmission and the engine and the computer system that's in there and the tires and the seats. If we did, we would overstate GDP for the year. We would overstate economic activity. So it's the market value of all final goods and services. And number 5 is important as well here, produced. So GDP measures what was produced, not necessarily what was consumed in the year. So as long as the production takes place within a given year, it's measured, it's counted towards that year's GDP. And in a later section, when we go through this piece by piece, we'll discuss how we account for goods that might be produced in a certain year but not sold. All right. Number 6 is also vitally important. We used to use a statistical measure called GNP, Gross National Product. Maybe some of you are old enough to remember that. I believe the year we switched over was 1991. It might have been 1992, but it's one of those 2 years. All right. But GDP, Gross Domestic Product, the D in there, Gross Domestic Product, we measure goods and services produced within the nation's borders, and it does not matter if the economic resources used to produce those goods are owned by foreigners or by Americans, as long as the production takes place here within the United States, whether it's the 48 states or Hawaii and Alaska, it would not matter, as long as the production takes place in the U.S. So let's stick with the automobile industry. Obviously, there's some Japanese automobile makers over here. So Honda cranks out a whole bunch of Honda Accords in plants right here in the good old U.S. of A. Matter of fact, a little statistic for you. The United States actually exports more Honda Accords than Japan does. So if a Honda Accord is produced here in the United States, that economic activity is counted towards U.S. GDP. And then the final idea of GDP, it's pretty straightforward, is that in a given time, so typically in a year's time. Now, GDP is reported quarterly, but when you hear the quarterly numbers, they actually annualize the data to make it easier to compare, right? So we get quarterly reports on gross domestic product, on economic activity, and then it's really a yearly comparison to a yearly period of time. All right, so what's not counted towards GDP? The first thing that's not counted towards GDP is financial transactions, purely financial transactions, because nothing was produced and no good was made available for sale. So for instance, first we have up there public transfer payments. In other words, the government sends a welfare check, an unemployment check, a Social Security check. All of these are, obviously necessary social welfare benefits. However, no good was produced and no service was provided, so we wouldn't want to count that towards gross domestic product, because GDP is trying to measure economic activity, final goods and services produced. So purely financial transactions, we call these transfer payments, government transfers or transfer payments. These would not be included in GDP. Likewise, private transfer payments. So, if you gifted money to someone or to some organization, again, it's a purely financial transaction. So there's no good produced, no service provided. Right? A good example of purely financial transactions is stock and bonds. So, Facebook just went public a couple hours ago. Here is literally about maybe like 48 hours ago, Facebook went public. Right? So if I bought Facebook, let's say I bought 100 shares of Facebook, and I bought it at the IPO price. Now the stocks actually went down in price, but assuming it went up in price, and then I resold it for a profit. Again, nothing was produced when I bought the shares and resold them. Right? No good was produced, no service was provided. Now, interestingly enough, you sort of have to be careful here. If I use, say, E-Trade to execute my trade, so when I bought the shares and when I sold the shares, if I had to pay that company, that corporation, E-Trade, if I had to pay them, say, $9 for the trade, that $9 would be counted towards GDP. So regardless of what the value of the stock is, whether it's $1 million or $100, the service paid to the stockbroker, or in this case the brokerage firm, that is a service, so that little piece of it would be counted towards GDP. But purely financial transactions, not counted. All right, secondhand sales. Let's say I had the foresight that, I wasn't alive back then, but let's say one of my relatives, my grandparents, had the foresight to buy a 64 Mustang. Right, the year they came out, this gorgeous American hot rod sports car, And they also had the foresight not only to buy that car, but to put it up on blocks and put it in a, in some garage where it was free from any type of environment and weather, and it was never damaged. So it's in pristine, perfect condition. So in 1964, that car may have sold for, say, $1,500. And now you could sell that beauty for, say, $50,000, right? Well, again, it was counted towards GDP in 1964, the year it was produced. So even though you would sell it for a higher price in this year because it's, it's obviously a collector's item, it still wouldn't be counted towards gross domestic product. All right, now there's two ways to measure GDP, right? Two ways to measure. On the left here, we have what's called the expenditures approach, and this is the one you're going to be much more responsible for. And on the right, we have the income approach, or the income approach. All right, so you can think of this as two sides to the very same coin, right? Two sides to the very same coin. And here's what I mean by that, right? Imagine if I walk into my barber, and I've been going to the same barber since I was about, like 8 years old, right? So I go in to see Bud the barber, and haircut is $13. Haircut is $13. From my standpoint, from where I'm sitting, that's $13 worth of expenditures. So it's spending on my. So we can add up either all the money that was spent on final goods and services, right? From the barber's standpoint, from Bud's standpoint, that's $13 worth of income, right? So we can either add up either all of the money that was spent on final goods and services, the expenditures approach, or the income that was generated in producing those very same goods and services. I'll say that one more time. So GDP can be evaluated or measured in two ways. We can either add up all of the money that was spent on final goods and services, the expenditures, or the income that was generated in producing those very same goods and services. Right? Now, we're going to spend a good deal of time on this expenditures approach, C plus I plus G plus X, right? So, but we'll use the income approach in the future just to explain some other relatively important statistics that we can derive from GDP. But the one you're going to be more responsible to understand and to learn, and the one that is most widely used in the public anyway, is the expenditures approach. So, GDP, let's go forward and talk about the expenditures approach. Personal consumption expenditures, C. So get used to these one-letter acronyms for specific parts of GDP. In a later slide, maybe I should have put this earlier, but I'll tell it to you now. Maybe you can write it down if you're taking notes. If not, it's on a later slide, so don't worry. But GDP equals C plus I plus G plus X. So we're going to explain those four letters and what they mean to the expenditures approach. So personal consumption expenditures, right? So people like you and I, we call these households. We spend money on, first and foremost, durable goods, and these are big ticket items. Things like furniture and computers and televisions and washing machines, right? And these are relatively important because they're big ticket items. They cost a good deal, so they actually have a significant impact on how much gross domestic product takes place, how much economic activity takes place in a year, right? The second thing we buy are non-durable goods. So durable goods typically last, 3 years or longer, something like that. Non-durable goods last a very short time. So, T-shirts and shampoo and soap and those type of things that we use up quickly and we dispose of them, so to speak. So durable goods, non-durable goods, and then finally services. And don't underestimate the importance of services. Something like 68% of all expenditures are on services. 68% of all expenditures are on services. So that's the easiest one because we're familiar with this. We're households, so individuals, households, consumer expenditures. The next of GDP is gross business investment, labeled I. Now there's I subscript G there, gross business investment, but typically we just say C plus I plus G plus X, so we don't say I subscript G. That's just a little cumbersome. So C plus I, gross business investment. So investment. Now we remember this when we studied the production possibility model. What is investment? Right? Hopefully you're thinking of the correct answer as I'm going through this. Investment is when a business purchases something like machinery, equipment, and tools. Right? So if let's say a landscaper needs some new mowers this season to cut the grass, that expenditure on equipment would be considered investment spending. And remember that investment spending, right? Those lawnmowers are now called capital, right? So that's capital investment. So these terms sort of go hand in hand, right? So if a manufacturer of, say, I don't know, we can use something simple like, furniture. A manufacturer of furniture needs some new machinery for their factory. Well, that would be gross business investment. That would count towards investment, right? Likewise, if any manufacturers of goods and services need tools to perform the activities necessary to produce goods and services, that too would be counted as gross business investment. So this includes both the purchase of new machinery, equipment, tools, right, and refurbishing any older equipment and tools. So that's all part of gross business investment, and that's the most important component of I, this machinery, equipment, and tools. All right, now, there's other parts of spending that are lumped in here with investment spending. All construction, so whether it's residential or commercial, all construction is considered part of investment. And you can see why commercial construction would be considered part of investment spending by businesses erecting whether it's we're here in Philadelphia, the giant Comcast building, right, or a small manufacturing plant. But the theory behind including all residential as well is that in theory you could rent your house out and make money off it. So that's why that's considered part of investment as well. Now remember, we said gross domestic product measures what was produced, not necessarily what was consumed. Right, that was part of our definition of GDP a couple slides ago. GDP measures what was produced, not necessarily what was consumed in a year. So here we have a way to take care of this statistical adjustment, so to speak. So let's say that a manufacturer of computers, they make some desktops here in the United States in the last week of November, right? So they were produced here in the United States, let's just say for sake of argument, they were produced in 2010, right, a year that's passed. So they were produced the last week of November, but they weren't sold until the following January. Well, they were produced in 2010, so we need to put those into, we need to calculate those into 2010 economic activity, 2010 GDP. So any increases in inventories would be added to GDP. And likewise, when they're sold in 2011, we subtract decreases from inventories out of GDP, right? So that way we are able to correctly and efficiently match economic activity to the proper period in which it takes place. All right, on the next slide, we're going to explain the difference between gross versus net investment. Gross versus net investment. And this is a relatively important idea, especially when we talk about going back, because everything goes back to our good old production possibility frontier. Is we're going to refer back to this time after time, and we're going to talk about a nation's ability to produce not only now but in the future. Right? So this is actually called net private domestic investment. On the next slide, we'll be able to explain this in much more detail. So here we have on the left-hand side a nation's stock of capital. So if we could go out there and we could count up the value of all goods and all capital, all machines and tools and equipment that we own as a nation, right? If we could do that as a nation, right, what would it be worth? Well, actually, believe it or not, the Bureau of Labor and Statistics, Bureau of Economic Analysis, they actually have a pretty good grasp on these numbers. The United States owns, and I'm going back a couple years, but it's a good rough estimate anyway, roughly $42 trillion worth of capital. Right? So if you added up all the tools and equipment and machines out there and say, okay, how much capital do we own as a country? Now remember, it's privately owned. That's one of the most important ideas associated with capitalism, is that with private ownership of capital. Now you understand where the term capitalism comes from, right? So what happens during the year? Well, two things happen during the year, right? Two things happen during the year. One is that some of this capital depreciates, right? So you see that gross investment. Some capital depreciates because machines start to wear out, right? We also call this consumption of fixed capital. So depreciation is synonymous with consumption of fixed capital. So let's just assume for sake of argument that, all right, we own $42 trillion worth of capital to begin the year, and let's say $2 trillion worth of depreciation takes place, because machines do wear out, tools start to go bad, right? You know, equipment just doesn't last forever, and it's just the nature of the beast. It's the way life is. Well, what happens if during that year businesses collectively as a country, businesses bought $3 trillion worth of machines and tools and equipment. So $3 trillion worth of investment in new equipment or refurbishing older equipment. Well, here we say, okay, well, in that case, spending on new equipment exceeded depreciation. So gross business investment on machines and equipment and tools, and that would be a good thing because at the end of the year, the nation's stock of capital would actually rise, would increase, right? So, and that would be good because if you think back to our production possibility frontier, that would mean that the curve would shift outward, right? We'd have the ability to produce more in the future. We'd have the ability to produce more goods and services in the future, right? If the nation's stock of capital shrinks, that means we actually have less productive capacity going forward. And that's exactly what happened during the Great Depression. The nation's stock of capital shrunk by 50%. By 50%. And now you can understand how and why the Great Depression became such an economic calamity that it did.